Before we dive in, a brief but important disclaimer. Made in Japan is an independent podcast co-hosted by Made in Japan and Ben Finzer, a portfolio manager at Fin Capital Management. Everything you hear on this show, including all opinions, analysis, and guest commentary, is provided solely for informational and educational purposes. Nothing on this podcast constitutes investment advice, a solicitation, or a recommendation to buy or sell any security or financial instrument. The views expressed by any host or guest are entirely their own and do not represent the positions, strategies, or views of Made in Japan or Fin Capital Management, its affiliates, its funds, or its investors. Investing carries risk, including the possible loss of principal. Past performance is not indicative of future results. Please consult a qualified financial advisor before making any investment decision. And with that, let's get into it.
Praveen, I was looking at your background. I thought it was interesting that it looks like you studied computer science in India. You actually worked for an engineering firm to make that move to focusing on Japanese equities. That seems, I guess, non-traditional. I'm super curious in hearing that story as you look back on your career, how you ended up focusing on Japan.
As you said, it's quite an unusual journey, not something that even in my circle of friends from my bachelor's degree or even my master's degree, I mean, even sort of wider circle, I can't think of anyone who's made that leap from tech to hardcore finance. So I started off post-bachelor's in computer science. So worked for about 6 years, initially starting off as a programmer, doing hardcore C++ on Unix. Not sure if you even remember Unix. And then I transitioned to more of a management consultant type role, focusing on software solutions for telecoms, logistics, warehousing. So basically software optimization type projects. During that period, I started investing a bit of my own money in the Indian markets just out of interest, because obviously, India was taking off big time. And my brother-in-law, so he's a fund manager at Franklin Templeton. So been having conversations with him all that time, and he just encouraged me to just play around with a little bit of money, just see whether I fancy that or I end up liking that or not. So that's how the interest in investing and research started. I knew that without a formal degree, if I wanted to transition into a full-time role within research, asset management sort of area, it would be quite difficult for me. So I took a year off to do an MBA from Cambridge. So I did that. And then I joined this firm called Baillie Gifford. It's based in Edinburgh. It's a 110-odd-year-old firm, global asset manager, pretty much a high growth philosophy. So I joined the firm almost 17 odd years ago. I started off covering US, emerging markets, Europe, for the first 2 or 3 years. And then I joined the Japanese team, which was a bit of a coincidence because I was asked which would be your top 2 teams that you want to go into after the first 2 or 3 years of training. Japan wasn't even on my list. Obviously, being from India, I felt maybe if I was in emerging markets, I could be able to add a lot more value. So I chose emerging markets and Europe. But around that time, there was a very senior analyst who was retiring from the Japanese team. So the chief of investment staff felt maybe I'll be a good fit for that team. So that's how I ended up being a part of the Japanese team. But yeah, it is probably one of the best things that's happened within my investment career. So I spent covering Japan 15, 16 odd years. I was the co-manager on an all-cap strategy, which is roughly around $1.5 billion US. I was also the sole lead manager on our Japan small cap strategy. So that was about 750 million.
You started Japan pretty early compared to many of the people that, have been investing in Japan today. Back then, the language barriers were higher. There was probably much less English disclosure as well. So what's been your learning curve like? How did you overcome these cultural and language barriers? And what were your first impressions of Japan back then?
Yeah, so I think there are 2 things which generally people conflate, which I think it's quite important to separate them. One is the language side of things and one is the culture side of things. Firstly, this is just my opinion. I think people tend to massively overemphasize the whole language thing. I don't feel knowing the Japanese language, the ability to read a tanshin or whatever, gives you any sort of an edge in terms of your analysis. I think what does give you an edge is a reasonably deep understanding of how the country works almost. What are the challenges? What are the solutions? Who are the solution providers? So just trying to build an understanding of what are the key areas of Japan where you're likely to see whether it's growth or change or those sorts of aspects. Speaking with management teams, etc., we've always used a translator. Yes, it's a bit of a pain in the backside, but it's pretty standard stuff. Even when I go to Japan, even almost all of the small caps I've met over the years, obviously in the last 5-10 years, we've had an influx of proper English speaking founders and entrepreneurs, so it's not much of an issue. But even going beyond the last 10 years, I've never really found language to be much of a barrier, to be honest. I think it's almost psychological when people say, oh, we need Japanese language expertise. I think it gives them some sort of a comfort blanket almost, saying that, oh, you've got a Japanese speaker in the team. But in terms of actual analysis, research, I personally don't think that gives you any kind of an edge. I think it's the culture side that's more important than the language, because if you gain some sort of an understanding of what Japanese culture is all about, this thing about societal harmony, things like that, there are a few elements that if you pick them up, you can link that back to the companies themselves. For example, why do Japanese companies find it so difficult to fire people? Right? So people have always complained, oh, if you want to cut costs, just lay off a quarter of your workforce. In the West, that's pretty common practice. But I think if you understand why Japanese companies don't tend to fire people, what are the cultural aspects behind that thought process, I think building that level of understanding is quite crucial.
I've had a similar opinion, which is that the language part, I think just through AI, just becomes easier to now actually be able to analyze Japanese companies through filings. It's easier than ever. I think one of the interesting things that some of my friends say has driven up the stock prices recently is that just development of AI has just made it much easier for foreign investors to analyze Japan. I'm actually just curious, like you said, on the cultural side, there are things that you need to keep in mind, whether it's about how to talk to the management, how to engage with them, or how to think about just the structural differences and how certain industries work to a comparable one abroad. So, what was that like for you early on? How did you try and adapt to that? Do you have any interesting examples that maybe you'll be able to share?
The most obvious one was when I did my first set of company meetings with management teams. So when I did my first year, a couple of years in the Japanese team, I very quickly realized that the Western way of approaching management teams, so Western management teams generally are quite open. They'll basically talk chapter and verse without actually answering your question, right? So it's quite bombastic. They like to talk their own shop, etc. Quite quickly, I realized that sort of style of conducting meetings doesn't necessarily work with the Japanese management team. So one of the things I picked up was you, in many ways, have got to create an environment or an atmosphere through your questions that make the management team feel as if you're almost on their side. Even if it's a company that's done pretty horrible things and you're absolutely upset, let's say it was a large position in your fund, you really want to reach across the table and shake them by the collar or whatever. I think it's very important to get them on your side almost, which means that the way you structure your questions, not necessarily going straight in with your main questions. For example, you can have a few starter for tens type questions to ease into the meeting. And also there are many ways of asking a question, right? So you can be very blunt and just ask them, okay, tell me why you've done this. Or equally, you can put it in a softer, almost encouraging way, saying, actually, that was quite an interesting decision. Can you just run me through the logic behind that, for example? So sometimes those very slight nuances can make a big difference. Obviously, if you've met management teams over the years, you start building a relationship and then it can open up a bit more. So I think conducting meetings, it's quite important to acknowledge the way Japanese, especially the traditional companies, they can be quite difficult to get through. So just making sure that it's a supportive environment for them, a supportive long-term shareholder. You're not necessarily there to harass them or whatever. I think that actually works quite well. And they'd be quite surprised at the sort of things management of their own volition end up telling you. I think with small caps, that's less of an issue because anyway, the sort of companies that we're looking at, they were quite gung-ho, quite dynamic. So they weren't averse to talking about quite, reasonably aggressive way by Japanese standards. So yeah, so in terms of company meetings, I think that those elements were quite important to pick up early on.
Baillie Gifford had global funds, and I'm curious how your cultural learnings in Japan over time informed your investing philosophy and your strategy, but also how your Japanese funds differed from maybe some of the other global funds that were also focused on growth or smaller companies.
Yeah, so within that, I think there's a couple of things worth bearing in mind. One is this has been a bit of a bugbear for me over the years. Whenever people, by people I mean investors, asset allocators, etc., whenever they talk about Japan, they're always asking the question, what's the catalyst this time? I absolutely hate that word catalyst. You don't ask people what's the catalyst for the US market or what's the catalyst for EM. So I think, unfortunately, for whatever reason, the Japanese market tends to be treated quite differently. Personally, I think a large part of that has to do with just people's outdated views of Japan. People are still looking at the post-bubble economy and the lost decade or whatever, the three deadly Ds, deflation, debt, and demographics. I think those are all very outdated views, but unfortunately, they're quite entrenched views. I would argue that the Japan of today is far cry from the basket case that it was made out to be 25, 30 years ago. Even when people talk about the lost decade, I don't think people realize that in real terms, the GDP actually grew. There are these little details that people just tend to sweep under the carpet. So I think in terms of foreign investors, the first obvious thing is to try and look at Japan just like you would any other market. By that I mean to say, if you've got a particular philosophy, style, so if you're a growth investor or a GARP kind of investor or a value investor, say in the US or emerging markets, whatever framework you're using for research, looking at industry background, competitive edge, you could apply the exact same framework to Japan. It's not much different. So the basics are absolutely the same. I think where the differences come are more in terms of the country specific issues. So every country has some specific domestic issues that it's grappling with. That's the bit where you need to tailor your approach a bit. So if you're, for example, if you're looking at some domestic sector, say retail, there you would have to have some sense of what's going on in the retail landscape. Think about consolidation. It's been a brutally competitive market for decades. So you're seeing a wave of M&A activity. So who are likely to be the winners? That sort of local context almost is quite important. So yeah, I mean, I always find it quite strange when people treat Japan as if it was a bit of a novelty almost. I think another thing that's enabled that view to become entrenched is the fact that over the years, Japan has basically become quite a small part of all these global indices. So it's almost become a bit like a rounding error. So people, I suppose, from that point of view, rightly ask the question as to what's the point of Japan. Obviously, there are loads of reasons, and we can go through that later in the podcast when you look at things like valuation, the growth rates you're seeing with companies across the market cap spectrum. You could argue that that sort of treatment of Japan is a bit unfair, but for people who are Japanophiles, that's the opportunity. Loads of people have just not quite given up, but they're still approaching Japan with that historical mindset. You can build an edge if you're investing in Japan today by saying, look, I don't think that view is correct anymore.
I was actually just wondering, based on what you just said as well, especially because Baillie Gifford has been focused more on growth companies. It's almost like a contrarian investment, specifically in Japan, especially today where governance has been improving. There's just so many of these value stocks which have incredibly high cash balances on their balance sheet. Sometimes it can be like 50% or even more of their market cap. These have been the main points of interest for many investors. So I was wondering, what's been the main interest for you guys in growth stocks in Japan? What was the opportunity there?
Baillie Gifford it's always been known as a growth manager. So in terms of the firm-wide philosophy, that's pretty much rooted in investing in growth companies. That's true of Japan as well. I think similar to the comments I made in the earlier question from Ben, I think even here, it's just this outdated view of Japan that because underlying all of that is still this fixation that people tend to have, although there's numerous academic studies, I can ping you a number of these are good, that have disproven this link. So people always correlate economic growth with stock market returns. The link between the correlation between these two is clearly being shown through numerous studies to be tenuous at best. But somehow in people's mind, they always look at, oh, India is growing at 7% per annum GDP or whatever. So that must be fantastic for the stock market. So what we always say is, look, we're not investing in an economy. We're investing in a company. So no matter what the economy does, what we are looking for are companies that are growing, that are basically masters of their own fortunes. So typically we don't tend to invest in companies that rely on some external factor going their way, if you see what I mean. Well, my favorite line has always been they live and die by their own decisions. That's the underlying thesis for companies that we have. Within that framework, we segment growth companies in Japan in kind of two categories, or at least I think of them in two categories. One would be your secular growth businesses where you get pretty fast top line growth, typically 10 to 15%. Over time, you get the gradual margin improvement. So these would be your kind of structural growth companies like online payments or e-commerce, etc. The other category of companies is where you're not going to get fast sales growth, but it's all about margin improvement. So it's the latter category of companies that you tend to see more of in Japan, which means that because there is obviously some limit in terms of how far margins can expand, that's precisely the reason why in Japan you don't tend to get these massive multi-baggers. So you don't tend to get many kind of 10x, 20x, 30x type stocks. It's literally a handful. But what you do get are numerous kind of 3 to 5x type opportunities, mostly focused on this margin expansion type story. Where you get the real big winners would be your things like M3 or GMO Payment Gateway, those types of structural long-term growth stories that start life as a small cap and eventually end up being a mega cap. But M3 has been around for donkey's years. We've not had another M3 in so many years. So you've got to be a bit careful in terms of how you calibrate the upside in Japan, simply because it's not really a market that can support a lot of those types of businesses. Another mental model you have is the domestic versus overseas type model, where you have domestic only businesses which are targeting certain specific areas. Obviously, you've got the soft banks of this world, the Toyotas of this world, all the factory automation companies, your Fanucs, your Harmonic Drive, etc., which have got a global opportunity. So that's another way of thinking about where you might want to look for good growth companies.
Just to double click on what you mentioned earlier, trying to find companies that are masters of their own fortunes. I think management execution for high growth companies is maybe even more important than for a steady growth proven business model. So I'm curious how you evaluate management teams, whether it comes down to more of a gut feeling or if you look at the historical performance to evaluate management, or if you have any unique insights when you're evaluating management's ability to execute a big growth plan.
Here again, I don't think we use any particularly clever techniques or to determine whether management are competent or not. If one thing that we do acknowledge, and this is again Japan specific, is the fact that Japanese management in general, they're starting off from a relatively low base when it comes to competence, the way they think about the business, the ambition, etc. So with that kind of acknowledgement, if you come across someone who's reasonably competent, they've got a vision for the company, you can argue that maybe that deserves a bit of a premium, for example. So just like with the company in any other market, we would look at things like insider ownership. Again, that's an area where Japan's not really being that high. There's no culture of high insider ownership, simply because most senior executives in Japan generally are very poorly paid. So if you compare the compensation of a Japanese CEO versus a US CEO, you're talking of a fraction. So there's no incentive for management teams in Japan to actually have big stakes, which is why almost 90% of the portfolios that I ran had holdings which were founder-led businesses. So we generally had a bias towards those sorts of businesses because that's where you get this strong alignment. Typically, you get founders with 40, 50% of their wealth in the company's shares. Hopefully that we think ensures a decent level of alignment with minorities. So you look at things like insider ownership, you look at things like the usual capital allocation type stuff. Have they been buying back shares? The shares are being very weak. Equally, have they been issuing shares, which is obviously not a good idea. I think the only thing you can do is have regular engagements with them. That's the only way in which you can build some sort of an insight. You're not going to build any clever view of management just by one meeting. So I think the management bit is, I would say it's more of an ongoing process rather than something that you can get it like this. So that does take a bit of time. As I said, management in Japan, going back to my comments about meetings with Japanese companies. So management teams in Japan, generally, the best of times can be quite guarded. So it takes a bit of time to break down some of those barriers and get them to feel a level of comfort with you that elevates the conversations you have with them to a different level. So that's what I would say. In terms of actual quantitative metrics, it's the pretty usual standard things that you can look at. But the more qualitative aspects do take a bit of time to build up.
Are there any heuristics you've developed or over your long career looking at Japan? Are there particular green flags? You mentioned some of them being skin in the game, equity alignment, but is there anything else that I guess you've learned and today when you see those characteristics present, you feel more confident?
Yeah, so when it comes to the proper growth companies, and this is more true of the small, of the SMID range, the one thing always very obvious red flag for me is whenever a company says that they've got global ambitions. So my kind of baseline is always, if there's a young company, whether it's an internet business or whatever it is, whether it's a brand or whatever, I've always believed you need to build some level of scale in the domestic market first. You need to build a base where you can say, look, I've got over half of the market in Japan. I'm the number one player or I'm the number two player. We are making decent level of profits in Japan. We're through with the capital intensive part of the growth trajectory. If you can say, okay, now look, we've done Japan, now how about thinking about Southeast Asia or whatever, that to me would be a lot more encouraging compared to someone who say only got about 20, 30 billion yen of sales and they're saying we're going to take over the world. That to me seems a bit like, do you actually know what you're talking about? Sort of question. So ambition is fine, but you need to get a sense that these guys are realistic as well. They've got a reasonably realistic plan, not just pie in the sky stuff. So that's the first obvious thing to watch out for. The other thing, when it comes to the more traditional companies that have been around for a while, I think for them, the one common thing I found is generally when you get an outsider coming in as the president. It could be someone who's completely unrelated to the founder or the family, or someone who's more of a professional manager who's had a bit of a track record and they're being brought in. Again, mind you, that doesn't happen that often in Japan. But whenever those sorts of situations arise, history suggests that actually the probability of success in terms of share price performance, operational performance for those companies can be quite high. A classic example I would give is Shiseido, where they had a terrible period, was basically going nowhere. Then they brought in Otani-san, who had done a phenomenal job with, I think, Coca-Cola Japan, was it? Or one of these big businesses that he turned around successfully. So he came in, he basically sorted the business out and the share price followed. Obviously, in the last few years, it's had a bit of a lurch downwards since he's gone. But that would be one example. So if you can see that sort of management change happening where you're getting an external individual come in, that might be an interesting company to do a bit of work on.
So you've mentioned management change as a key. I know you don't like the term, but catalyst. And we've seen this with also generational changes too, with certain companies where the founder might have passed, but then the younger generation really is able to implement the changes that they've always wanted to, but the founder was quite reluctant on. Some of these companies, as a result, can also just bloom through that as well. Most recently, there's examples like Sanrio, which is they do Hello Kitty. The generational change there has brought a lot of fresh air into the management, the company itself, and it's really bloomed in that sense. I'm more curious throughout your time in Japan, who were the standout CEOs or founders or management teams to you? Why were they so memorable?
So obviously, starting at the top, we've got someone like Mr. Son, who was, I think my view of Mr. Son is, and this is not how the majority of people think, I suspect, is he loves making money. That's the first thing you need to understand. That's basically, that should be the first line of any softback investment case. Right? Forget about doing a deep dive into their VC portfolio. You can spend 10 years and still get nowhere. I think that misses the point. So he's someone who's had a phenomenal history from selling DVDs or whatever to getting to where he is at the moment. That's not without taking huge risks. So he's almost like a calculated risk taker. So if you want to invest in SoftBank, I always say to people, the investment case is just one line. It's all about Mr. Son. Market's view of Mr. Son is a bit like a pendulum. So basically it goes from an idiot to a genius. So you basically need to buy the shares when the pendulum goes towards the idiot side. As it swings towards the genius side, that's when you take profits, basically. So Mr. Son, obviously, he's inspired numerous books. A lot of young founders, entrepreneurs I've met have cited him as someone that they look up to and are inspired by. So he would be one obvious example. The more domestic end, someone like Fujita-san of Cyber Agent, he's also done a phenomenal job. You've got people like Tanimura-san of M3. He's obviously built a big healthcare beast that's a genuine global business. Further down the market cap spectrum, you have people like Higuchi-san of GA Technologies, which is this online real estate business. So, there are quite a few. You got Motoe-san of Bengoshi.com. Again, really smart person, knows what he's doing. So, there's no shortage of these sorts of really dynamic individuals. It's just that outside of Japan, very few people have actually heard of them, which is part of the problem, going back to your earlier question, well, in terms of people's perception about Japan, etc. I think I'm always amazed and amused that people seem to have these really sophisticated views of Japan, how and why it's a basket case or whatever, but they've never once set foot in the country. So it's just always a bit hilarious that you're making all these expert comments on a particular market and you've not even visited the country there.
I think your track record during that period of stagnation or when the market didn't do much is further testament to your point. You're not necessarily investing in the economy as a whole. You're trying to find a basket of fast growing, high return potential businesses. In a market as deep as Japan, maybe that's actually easier to do than maybe a lot of outsiders realize.
Yeah, I think, again, this is not necessarily the way people tend to think about Japan, but I almost think that this lack of information that people complain about, this language or whatever, we've almost considered all of those as a bit of an edge for us. Because basically, everyone sits in Edinburgh, we don't have offices elsewhere, quite far away from all this noise. Really, again, going back to this point about why should you treat Japan any different from any other market? You basically follow the same fundamental principles, same kind of research framework, look at industry background, competitive edge, financials, management, valuation. Why should it be any different? Obviously, there will be some nuances, but broadly speaking, it's the same kind of framework you can apply in different markets. So I think this lack of kind of interest or information vacuum or whatever you want to call it, I almost feel that that's been a bit of an advantage for us because we've been willing to do the legwork, visited Japan at least twice a year in the last 15, 16 years, spent extended periods of time there with my family, go out and see 70, 80 companies over a 5-6 week period. That's how you build your knowledge base. That's how I would think about it.
I am curious how you screen. I imagine your answer will be it's not that much different in Japan than it is elsewhere, although just the sheer number of companies is far greater than many other single country markets. Given a lot of the criteria that you've mentioned before, is there a unique way or a particularly successful way that you found some of your best ideas early through screening or other methods?
This is always the most difficult question for me to answer. Trust me. Because the simple answer to your question is I've never really tended to use any screens, just have the very basic Bloomberg screen set up, but it doesn't really form a big part of the idea generation process for me or even for the Japanese team. I think my view has always been half the battle is won if you know where not to look for ideas, right? Obviously, we have a very limited amount of time. Our mental bandwidths are quite limited, and there's only that much that we can devote to proper hardcore research. So my view has been, why would you want to waste that just spreading yourself quite widely instead of being a lot more focused? So that coupled with this whole kind of philosophy around growth companies has meant that the actual number of companies that would be of interest to me and to the team are actually quite small. So for example, I don't know if we've ever invested in, say, an oil and gas company, for instance, in Japan. I mean, we did own Inpex for a long time, but there was a specific investment case for that. I don't think we've ever invested in any of these forestry or pulp and paper, those sorts of really traditional industries. We've never invested in a utility company, for example. There are areas of the market that you would struggle to find any kind of growth angle in those sectors. So what that means is you start applying a mental filter like that, suddenly find you've excluded half the market. For example, I'm just exaggerating a bit, significant chunk of the market. And then you use your knowledge of Japan saying, look, I've spent the last 20, 30 years investing in this market. I know which are the areas where change is happening, which are the areas where there is likely to be strong growth, e-commerce, it could be the telecom sector, got a disruptive player in Rakuten, for example. You got the online finance, you got the drugstores, the retail side consolidation, you got the brands. So, you start using your knowledge and then quickly can make a very reasonable list of 7 or 8 sectors or almost themes that are taking place in Japan at the moment. Once you've done that, basically just find the best company or the company that's growing the fastest, which ticks a lot of the boxes in those sectors. So that bit involves a lot of reading, talking to a number of companies. For us, because we had a kind of a market cap limit as well, so we wouldn't go below, say, 30 or 40 billion yen market cap. So that again meant that some of the really illiquid ones were screened off. So effectively, the actual pool that we were fishing in, after applying all these filters, you're talking of hardly 250, 300 stocks. This is across the market cap spectrum. Just to give you an example, my last successful idea, which was a stock that I researched and we bought it for my funds and one of the all cap funds in 2022, I think, is 5805. SWCC Sure. So this was basically an electrical cable and wire manufacturers, none of these sexy growth areas. So I read an interview in some random magazine of the president. It's a female president. Now she's become the chair of the board. She was the only female president in that entire sector. She was the first one to come from an R&D background. So she's got a PhD in superconductivity. So she had come in, obviously instituted a lot of change, focus on some of the high margin products. There was a bit of a labor shortage angle to the business in the sense that one of the new products was designed to reduce the time to install these transformers by up to a third, for example. So, small bits of change and clear evidence that this is a business that's actually moving in the right direction. So we took a holding when it was on 4-5 times P, making low single-digit operating margins. Today, its operating margins are about 10-11%. It's been a 6-7 bagger. It's re-rated to almost 20 times P, which means that's the other thing about Japan. Maybe I should have mentioned this earlier. It's very important to understand that you should not overstay your welcome. This is a market where, not like the US, where you can hold, I don't know, Fastenal or one of these other franchise businesses for donkey's years. It's quite tricky to do that in Japan. You've got to know when you've got to take your money and run for the hills. So yeah, sometimes you just come across a company just in the course of your normal reading. But otherwise, it's a slight kind of top-down element to the way we think about the new ideas.
I just wanted to clarify something and also follow on to that a little bit, because one of the things I understood about Baillie Gifford is the fund strategy really tries to look out 5 or even 10 years out. Part of the edge that they've created through these growth investments was because of that long time horizon. So how do you try and balance that with what you just said about not overstaying your welcome in some of these companies, which can really run up really quickly in a very short time? How do you try and balance those two?
So in this business, you basically got two tasks. One is the stock picking task. One is the portfolio construction task. I almost always think that the stock picking bit of it is the easier bit. But the really tricky one, and which is where PMs actually add the most value, is in the portfolio construction bit. Precisely for the example that you gave just now. If you bought a stock saying, okay, my base case thesis is in the next 5 years, this will at least double. Let's say if that doubling happens in the next 12 months, what do you do? So there you've got to strike a balance between being pragmatic whilst being long-term. Being long-term doesn't mean that you don't change things, right? If anything, that's the danger. As a long-term investor, you shouldn't become hostage to your philosophy. So my former boss always used to say, and she had a 40-year track record of investing in Japan, phenomenal investor, a lady called Sarah Whitley. She always said that, look, if you came into the office one morning, you found out that the world had changed, it would be very odd for your portfolios not to change. So it's that sort of thought process. That if you feel the market's perception of a stock has changed, people have gotten onto the story or whatever, you can see that in the number, the share price or whatever, it would be a bit odd not to take action. The action may not be a complete sale if you still believe that there is a lot more juice in the growth story or whatever, in which case the answer might be a significant cut to your holding, significant taking of profits. Or if you believe that there's not much upside, you just sell and move on. But being long term, it's always Baillie Gifford's starting point, but that doesn't mean that we are just ignoring what's happening with the share price. So on the portfolio construction side, we do take quite decisive action whenever there's this sort of move on the upside. So it's a balance to be struck.
I'm wondering why the Japanese market is maybe different from the US market in that sense, where you mentioned Fastenal, or there's so many other examples. But I think in some ways, India maybe has been a market like the US as well. When I read Pulak Prasad's book, What I Learned About Investing from Darwin, his strategy really, it seems, is to buy and hold really and never sell. So I guess maybe sharing some insights on what makes the Japanese market different from maybe the Indian market or the US market in that sense.
As I mentioned earlier, I think the most obvious difference is that it's still the third, fourth, or whatever largest economy in the world, but there's not that level of sustained long-term growth that one can expect from Japan that would help sustain a lot of companies growing within that, for example. So that's where kind of the top-down thinking comes into the picture. You mentioned India, it's the fastest growing economy in the world based on most recent GDP figures or whatever. It's got a huge, I think it's the world's most populous country at the moment, I think. It's probably overtaken China. So there's no shortage of growth areas. And it's got the youngest population in the world. If you look at the population graph, all the sort of things that Japan doesn't have. So at some stage, some way, you would need to factor those aspects in, which means that we formed M3 and Morotaro for 18, 19 years, all the way from, there were small caps. We've actually seen a very noticeable, clear fade out of the growth rates. So I'm not saying that the growth story is over. I'm just saying that that they've entered a new phase. Whereas you can have businesses in the US, or I mean, in the US, even some of the mega caps are still doing pretty amazing growth rates, even after whatever years. So that's the difference, which is why I think people implicitly apply a discount to the market. You look at some of the stocks in India and in the US, a lot of even the raciest Japanese growth companies can only dream of getting those sorts of multiples, right? The reason they don't tend to get those sort of multiples is precisely because of the market opportunity perhaps for them isn't as big or as global as it is for these other companies. If these are domestic only businesses, then again, it's not that fast growing a market. The other thing to bear in mind about Japan, this cuts across sectors, is it's an extremely brutally competitive market. There are no areas in Japan, if it's a very new industry or new sector, I've never seen the speed with which new entrants come in. I've never seen that sort of speed in any other market. I think Japan's probably the worst. So I don't think, this one of the elements of competitor edge is first mover advantage. I think when applied to Japan, I don't think you should be doing that, because I don't think the first mover advantage type edge applies in Japan.
That's really interesting, actually. I'm curious, when you talk about these businesses, what are the typical types of competitive advantages that you look for in Japan? Are there ones that are more typical that you find, or can that really be various when you look for them?
That's partly one of the key challenges. Competitive advantage, generally speaking, in Japan can be a bit fleeting. It's very difficult to find companies that have sustainable competitive advantage over a long period of time. But what I found, I can go through some examples, is one of the more common sources of competitive edge in Japan is nothing to do with products or services or patents or technology or whatever. It's simply the whole business model itself. Because Japan has unique problems, unique structures. So companies have had to come up with unique models to address those structures, to address those problems, to take advantage of that sort of setup, which is a big positive. The negative obviously would be that model will not work anywhere else. So one example being Infomart, which is an online B2B food ordering service. I've been part of a 2 or 3 member team that's launched international strategies. I've looked at European stocks, EM stocks. There's no business like Infomart anywhere else. The reason Infomart exists is simply because of the unique practice of using fax machines, telephones to even to order stuff for restaurants, right? So there is that very Japan specific problem that Infomart is addressing. It's got almost 2 trillion yen's worth of GMV at the moment, which is quite staggering. So that, I think, to me is generally the more common that I've seen in terms of source of an edge, the whole business model itself, because the software that they use, the database, etc., that in itself, there's nothing unique. Yes, they have millions of records or whatever, but it's not that special. What is special is just the whole model where it sits between the food manufacturers, the restaurants, and then it can just, along with the food ordering service, it can plug in a number of other services. So things like invoicing, for example, helping them with their tax planning. It becomes a bit of a flywheel type model, or at least that's the hope. So Infomart would be one example. Another example would be something like a bingoshi.com. So again, legal advice online. There are a few sites in the US, even in the UK, but nothing compares to the sophistication and services that bingoshi.com offers. So that's again quite a Japan specific model. So you do get, even in retail, I don't know if you've come across 3349 Cosmos Pharmaceutical. So it's the lowest cost. It's like the Walmart, everyday low price type strategy, but a strategy that is completely organic. So it was founded in the early 1980s. They've not done a single acquisition. They've grown completely organically, and sales are well over 1 trillion yen. So it started in Kyushu and now they're expanding in other regions. Their model is basically have all standardized stores. They don't take any card payments or whatever, or maybe some cards, so keep the costs very low. It's all about the inventory turnover. So basically the model is they're not looking at expanding margins to 6, 7, 8%. Their model is to keep the margins flat and reinvest all the profits in pricing, which means that you eventually end up with almost an unbeatable model. People can't compete with them on price. Even national brands, they're able to sell it at the cheapest price available. They basically kill the competition that way, which is what they've been doing in Kyushu, and gradually they're expanding into the Kansai region as well. So you get these sorts of Japan-specific models where the competitive advantage is basically a single sentence, which is business model is the edge. Because I think people have a tendency to try really hard to find out, oh, is it distribution? Is it something clever that they're doing? Is it some clever database they have? Ultimately, it could just simply be being in the right place, right time with the right business model. That's about it.
When you find a new idea, how do you construct the portfolio around these ideas? Do you start out with farm team positions and then build up to a full position over time as the company proves itself? It'd be helpful to understand kind of your risk management approach and specifically sell discipline, because you said earlier a lot of these companies can get out over their skis and valuations can exceed fair value. It does make sense to trim around the edges. If you want to use a specific example or any kind of best practices that you've developed over time would be, I think, very interesting to hear.
As with most things in investing, I always try to keep things simple because our jobs are complicated as it is. You don't want to add further complication to it. So I've generally run relatively concentrated portfolios, so 40 to 50 stocks on average. So the average holding size would be about 2% or something around that. So in terms of when we first buy a stock, it depends on obviously liquidity. So if it's a large cap, liquidity is not an issue. Typically, I would go in at 1% to start with, look to average up over time, eventually get it to 2%. But again, every holding, every position size is reflective of my conviction. So in the all-cap fund, for example, we had SoftBank at almost 9% of the fund because we felt that there is this massive sum of the parts opportunity. This whole AI thing is SoftBank is at the vanguard of that whole shift. If it's a more smaller end of the spectrum where the stock trades by appointment or it's not that liquid, I'll try and get in at least 20, 30 basis points holding just to have a holding. We've seen examples where, if the stock does its stuff, people start getting interested, liquidity improves, and then they could get a slightly larger holding. So that's really it in terms of position sizing. Obviously, when the stock goes up, depending on how much more upside we think there is. So every stock, we try and view it at least once a year. So every year, every stock in the portfolio, we will do a full update research note saying, okay, what was the original thesis? What's happened since we bought the shares? Does the original case still stack up? Should we be adding? Should we be trimming? Just trying to work around those sorts of questions. We have a discussion on the team. Eventually, we decide what to do. So that also because we are looking at specific companies, we're not really being driven by the benchmark. So our portfolios have tended to look very different. We measure that difference using this metric called active share. So the portfolios that I've run have generally had over 90% active share, which means that there's hardly any overlap with the benchmark. And although all of us are generalists, we don't have any particular sector specialism. We just are driven more by just the attractiveness of individual ideas. Having said that, we obviously are conscious of having too much in a particular sector. So we have some loose guidelines at the team level saying, okay, we wouldn't have, more than 10% or 15% in, utilities or whatever it is. But that's just a very loose guideline. It's not, if we want to go beyond that, we can do that. It's just almost a sense check mechanism. So we have a separate investment risk team that do a report for every fund in the team once a quarter. So we sit down with them, we look at things like tracking error, thematic risk, all those sorts of quantitative metrics. Sometimes we also give them specific bespoke projects to do. So for the small cap funds, for instance, one of the things I ask them to work on was to try and work out, looking at the past 20, 25 years worth of data, trying to see on average, what's the level of market cap at which companies really struggle to kick off? So is there an implicit ceiling, 100 billion yen, for example? So typically what we found is once companies get to that, going from there to the next 200 becomes really difficult. Going from 30 to 50 to 100 is the easy bit. Stuff like that. Just some interesting insights. So that really is how I've managed portfolios. And sell discipline, again, it just comes back to this idea of annual updates of stocks. Does it still stack up as an investment? Have the shares done their stuff, or has something gone horribly wrong? In which case, we wouldn't blindly sell the stock. The first course of action would be to have a follow-on meeting with the main person. Just try to work out whatever happened with the share price. Is that a reaction to maybe a temporary problem? In which case, we would actually be looking to add. Or is there something fundamentally gone wrong with some aspect of the investment case, which would mean that the investment case is broken, in which case we would look at gradually exiting the position. So that would be very broadly speaking how self-discipline works.
When things go well, I find that can be some of the most challenging sells because yes, the stock has reached the target price and the valuation looks full, but in many cases, momentum is a powerful force and companies can exceed that level, and greed and many other elements play in, but also sometimes companies do grow into their valuation. So maybe just hearing a bit more about when stocks work, how you view that trade-off and how that informs your decisions.
Yeah, that's always the challenge, right? It's a bit of a horses for courses type thinking that you've got to use. SoftBank is a classic example, right? It's gone through the roof in the last 12, 18 months. It's been the biggest contributor to performance. What's single biggest contributor to performance in the last 12 months for the all cap fund that I was managing? So what do? Do you say, oh, it's all the AI hype is baked in, some of the parts isn't looking as attractive? Do we just sell it? There's these concerns in the US, but all the sort of AI stocks valuations are massively overstretched. So that's one part of the thinking. So one course of action you could say is a simpler one would be just to sell the whole position, saying it's done its stuff. Any upside from here looks really difficult. Or you could take a view that, look, yes, it's done very well. The sum of the parts discount has narrowed, but if there's still a bit of a discount, that's sort of in the starting point. They say, okay, Mr. Son has a track record of pulling rabbits out of the hat in terms of making investments. Obviously, got the potential IPO of Anthropic coming up. We've got something similar what happened with OpenAI, so that there's some value crystallization opportunities there. So rather than thinking too narrowly about, oh, the share price has gone up, let's sell. What we've generally tried to do is just think a bit more broadly, take a step back from the share price. Just think, okay, this excitement that we've seen, what is causing that? Question number one. Question number two, is there any other potential excitement that's to come that the market is completely unaware of? In which case, this thing could keep motoring for the next 12, 24 months. So that would be the more positive spin, the positive thinking in terms of why you would want to hold on. Equally, let's say if it's somewhat a cyclical business, it's in shipping or whatever, people have just gotten very excited about the prospects of global trade improving or whatever. I think the key difference to make is to try and work out, keeping the share price in mind, has anything fundamentally changed with the investment case? Has anything gotten better? Has nothing changed, or has anything gotten worse? I think trying to answer these three questions will give you the answer to the ultimate question of what you should be doing with that position. If you feel, yes, the share price has gone up, but the fundamentals have actually improved. If you take the view that not all of these improvements are in the price, you might want to hold on, maybe trim a bit off the edges. If you feel this has been absolutely no change in fundamentals, but it's just some market fraud that people have just gotten excited, you might want to be a bit more aggressive in terms of chopping the position size if you still like the company. If you feel actually things have not really changed, in fact, if anything, at the margins, there's been some negative stuff that's happened, yet you've seen the share price move, you know the answer yourself. So I think that's another way of thinking about it.
I actually wanted to talk a little bit more about individual companies now. And to start, I would like to just explore some of the companies that you've invested through Baillie Gifford in the past. You guys have invested in what are large caps today, like Kiences or Monotaros, back when it was still tiny. Can you walk us through how you managed to uncover these stocks and what you saw in them from very early on?
In trying to identify these sorts of really long-term structural growth stories, the really big winners. And if you're trying to catch them when they're quite young, I think the first thing you need to bear in mind very clearly is you're not going to get all the answers to your question. You will never be able to tick all the boxes. There will always be aspects of the case that are complete unknowns where you're not even sure what the competitive edge is. So that is the first thing you've got to bear in mind. Trying to make decisions with really minimal information. And the smaller you go, the more acute the problem becomes in Japan, although that's improved over the years, but it's still a bit of an issue. So once you've got that in your mind, the second thing that's worth thinking, that's always worked for me, is just trying to work out, firstly, what is it that the company is trying to do in terms of its business? Are there any unique aspects to what they're trying to do, or is it just one of many? So, for example, when Molotaro started, when M3 started, what they were attempting to do was quite different, quite ambitious. There wasn't an online medical marketing platform in Japan. People didn't even know what medical marketing online was. Monotaro, again, very much online B2B distribution model. Yes, there was, I think, ASCII, but it was still a marginal player at the time. So again, there's a bit of novelty. Digital payments with Geo Payment Gateway, for example. So there are some of these things that you can actually identify and work out, saying, okay, this is quite a unique proposition here. And the ones that tend to be really successful, obviously execution is very crucial, but tends to be companies that are actually solving some structural issues. So like in the beginning, I mentioned problem solvers. Just trying to understand, is there a particular problem that this company is attacking or trying to address? So that might help you calibrate what the value proposition of the company is and how unique it is. So once you've done that, personally, I've always felt it a bit of a thankless task or a waste of time trying to think about competitive edge, because at that stage, these are all very young companies. They'll probably have no discernible competitive edge. But what is more important is to think, do they have the building blocks of what could be an edge in 5 or 10 years? So that forward-looking mindset when it comes to thinking about edge can be very helpful, rather than saying, okay, what is this edge now, distribution or whatever. They will always fall flat in that sort of static analysis. And once you've formed a view of that, then, it just comes back to the usual in terms of growth rates, valuation, the market cap, how big could this get in 5 years, 10 years, or whatever, just the usual kind of scenario analysis. One example, which I think it's just below midway in its journey to getting to that stage, is a company called Katitas, 8919. So this is a company that actually buys really old houses. They're called Akia, that people have abandoned or whatever, and then they renovate them and sell it to first-time buyers. So this is a model that's exceptionally difficult to execute, because you're not talking of building a block of flats, which is far easier. You're talking of individual houses spread across Japan. You've got to have the national scale to have these people come in and do all the work, all the carpenters, all the painters, etc. You need to have the scale to be able to project manage. You can almost think of these as individual projects. So these guys have mastered a business model that does exactly that. And almost everyone has quit that sort of market because it's just not economically feasible for them. So these guys are essentially the last men standing, and they're addressing a couple of pretty serious issues. One is the huge number of empty houses in Japan, and the problem is only going to get worse. And the second issue is with rising interest rates, etc., they're actually providing almost affordable housing as well. So people who are currently renting, if they were to buy a Katita's renovated house, taking a bank loan, their kind of monthly bank EMI, the monthly mortgage payments actually work out lower than the rent payments. If there's quite a clear economic incentive for young families, young couples to get onto the property ladder. That would be one example of a company that's got this really solid edge, starting off as a business that had questionable edge, but the building blocks were there. And now they've consolidated. Now they've become kind of clear market leader, pulled ahead of loads of other players. And now the kickoff phase will hopefully happen in the next 5-10 years. This is not going to grow at 20-30%. It's more about you churn out 10% per annum top line growth. You get margin improvement through scale benefits coming through. They can negotiate much harder on the procurement side. They get gradual gross margin improvement. It's not a particularly labor intensive business, so none of that gross margin drops down to the operating margin level. You add in a few dividends, etc., you can easily get 10-20% earnings growth for a very long period of time.
Listeners might be surprised to hear about people abandoning their homes. So I'm not sure if maybe it's interesting or if you have additional color to provide on this industry and the opportunity that exists.
Yeah, again, this is one of the areas where Japan is quite unique, home ownership. Historically speaking, especially since the Second World War, when I remember Sarah, who my former boss, and she invested in Japan through the bubble years. She always talks about this anecdote that just before the bubble burst, when one of her trips to Tokyo, she actually saw these salarymen standing outside some club in Ginza waiting for a taxi, and they would wave these wads of cash. So the level of excess was to that extent, right? So through that period, what's happened is Japanese have generally developed a desire to have everything new, everything firsthand. And also there has always been some kind of cultural aversion, I think, against using other people's stuff. And that's extended to housing as well, which is why if you compare Japan with, say, the UK or US or some of all the other developed markets, the percentage of people who live in a second-hand house is, in the UK, it's about 90%, if not more. In Japan, I think it's the inverse. So it's still sort of 10 to 15%, maybe marginally more in terms of the people who actually live in a second-hand house. So there is that structural opportunity. Obviously, the younger generation attitudes are changing. They don't really have that level of disposable income that they can spend on new builds, etc. It's vast majority of Japan's wealth, unfortunately, is concentrated amongst the boomer generation, the slightly older generation. So what that means is affordability is a big issue, especially with things like inflation now becoming a lot more embedded, rates going up. So that, I think, is a very favorable backdrop for a business like Katitas. The interesting is they don't really operate in the metros like Tokyo, Osaka, Fukuoka, etc. They are actually operating in the suburban regional areas. So you get much more bang for your buck. Nowadays, work from home is becoming a lot more common in Japan. So people are saying, why would I want to stay in Tokyo, spending an arm and a leg, living in a few tens of square meters width of apartment? Whereas if I just take one of the Yamanote lines or whatever and just go the outskirts of Tokyo, I can get this pretty decent sized 2-bed detached house. They do only detached houses actually, albeit the second hand one, and have a much better quality of life, generally speaking. So these are the sort of tailwinds that a business like Katitas has, and just an understanding of these Japan specific factors can go a long way in terms of hunting for ideas.
So to summarize, this is probably an industry where Katitas has been able to build enough scale that's becoming more difficult for others to replicate their model in a cost-effective manner and to be profitable. And one of the big tailwinds that you mentioned is, again, higher house prices and inflation in Japan, making it less affordable for younger generations to buy homes, as well as like the number of Akia, which, to add some context there, there's a very high inheritance tax involved for households. And a lot of the times that estate can be pretty liquid and comes in forms of houses. And that's what leads to some of these people selling their houses for almost pretty much free. And that's where Katitas' opportunity lies in terms of purchasing these very cheap assets and then turning them into livable homes. But how much of that is left in Japan, would you say, for companies like Katitas to really take advantage of?
The thing to bear in mind is the number of empty homes is not a static number. So the last I read was there were about 8 million homes. Now, I'm not saying that 8 million homes is Katitas' addressable market. It's not, because they only ever buy one out of every, 10, 20 houses that they look at, right? And the thing is, this is a problem that's not going to go away. Now, there's suddenly not going to have all the people who abandoned their homes, the subsequent generations coming back, and there's a lot of them living and working in the metros and build their lives there. So these are all like abandoned for good. And given the demographic issues, you'll only get more and more of these houses popping up across the regions mainly. So that 8 million figure is not a static figure. So that's the first point to make. And the second point is, what that means is Katitas can basically pick and choose which property they want to buy. So one of the main things that they're very careful of when it comes to procurement is to make sure that the house that they buy structurally is still sound. Because the worst thing for them would be to buy a house and then find out that the whole thing is basically on the verge of collapse. So the structure should be sound. It should have almost like a skeletal structure around it. Termites are a big issue. So there's checking for termites, checking for earthquake resistance, really basic things like that. You start applying those sorts of filters, and it is no surprise that they're only buying a small number of houses relative to the overall number of houses that they look at. And because they're now virtually the only big player in town, now they're having the local municipalities actually calling them and saying, look, in this particular area, we've got 3 of these houses empty. Can you send someone to have a look? So even the procurement, the cost is actually been going down quite a bit, which is part of the reason why it's never really been a cheap stock. I still think it's quite cheap given all these attractions, but in terms of absolute multiples, it's not really been a cheap stock. So some of these attractions, you could argue, have been reflected in the valuation.
Just shifting gears, I wanted to talk a little bit more about a specific sector which you may have looked into, which is the SaaS industry in Japan. On the whole, it's traded at a pretty significant discount to global markets. One of the companies that you've mentioned in our past conversations has been Saibozu, which is an incredibly interesting company, a unique product, I would say, made for Japan, but also they've been very difficult to access in terms of IR. But you've spoken to them in the past, so I'd be curious to hear what you think about them and about the software industry as a whole of Japan.
So to start off with the overall SaaS sector, when you say software as a service, it's a very broad terminology, right? So within that, you can have accounting, you can have ERP type stuff, you can have groupware, which is what Saibozu does. So personally, I'm not a big fan of the overall SaaS sector in Japan. And the main reason for that is, even though it's a very nascent sector, it goes back to the point I was making about how Japan, or certain sectors in Japan, can get brutally competitive very quickly. That's exactly what you've seen happen in the SaaS sector. So companies are still in the investment phase, are still racking up losses, very early stage, and already you're seeing multiple players, right? So that situation is not going to moderate. If anything, I think it's only going to get worse. So that's a very high level general opinion. Now, within SaaS, you have some verticals where certain companies have managed to carve out a niche. And I think Saibozu is an example of that, where they've carved out a niche within the groupware, shareware type offering. And within that, they've targeted specifically the local authorities, the local municipalities. They've not really gone down the traditional B2B type route. They've targeted the more kind of almost the public sector. And I think they've been very clever in doing that because there is a massive need of this sort of automation in the public sector, which is still very much paper, pen, fax dominated. And through that, they can get follow-on contracts from suppliers and other entities that deal with these local authorities. So they've been very clever in terms of their strategy. Whereas other SaaS accounting firms like Free and Money Forward, I just think they've got so many issues with their business model. Although both the companies are held in one of our funds, have never really been a big fan of these SaaS businesses. Obviously, the investment case is basically it's a jam tomorrow story, right? So they're making losses today, but the hope is be able to make huge amount of profits tomorrow. I think that's quite optimistic. They might make a profit, but the degree of profit, the level of margin, I think might not be what people expect, mainly because of competition. Which is why I like things like Cybozo. Infomart would be another example. That's also a SaaS, but that's a very niche specific segment within SaaS. Bengoshi would be another similar example. So you do get a lot of these companies that have carved out a niche, but the ones in the more mainstream areas like accounting or invoicing, that's where I slightly struggle to build any conviction.
The key distinction here being that some of the companies that you prefer in the entire SaaS category will be more companies that have already been able to generate profits while being able to scale.
So that's a consequence. The reason why I'm positive is, again, going back to this idea that they built a differentiated business model. So their edge, I don't think Cybozo has any particularly clever technology, or yes, it's a very versatile product, the Kintone product. But I think it's just the whole business model centered around close relationships with local authorities, training their people in how to use Kintone, the whole ethos of marketing. It's not just your classic aggressive marketing tactics, it's working with them sort of philosophy. And they've almost built a moat around their business within that space. I suppose if you're being bearish, obvious question would be how big is the opportunity? Is it like of the order of a few trillions of yen, much smaller? So there we can have a bit of a debate, but generally speaking, that's the basic element is just the uniqueness of the differentiation. Because if you look at Free, Money Forward, Rackers, well, I really struggle to find out what's different in terms of what these companies are offering. I mean, they will obviously claim, or the default answer that they all fall back on is just saying in terms of, oh, Free, Daisuke-san will say we focus only on the SMEs or whatever, and Money Forward, Suji-san will say, oh no, we focus on the larger company. That's sort of a genuine differentiation, which is why Infomart, Bengoshi, Cybozo were the ones that have a very clear, distinct offering.
For the listeners, would you mind telling us what Kintone does and why Kintone as a product is so interesting in Japan?
So it's basically a no-code platform, which means that this is a software tool that can be installed by someone who doesn't have any programming or any coding expertise. So it's very user-friendly, very easy to install. And once installed, what does it do? So this is a multifunctional tool that helps with things like project management, collaboration with other co-workers, exchanging internal messaging, or working within the framework of those messaging. So if you have a project that involves multiple people, so instead of emailing drafts, I'm giving a very basic, simple example. So emailing a draft of a particular document around 20 people and then making changes to that. How do you keep on track of those changes? If someone has an idea, how do they communicate those ideas to you? So all that sort of stuff, you basically can use Kintone to do that. So it's like one of its functions is to act as a central repository of ideas. And on top of it, you have additional modules that I suppose you can subscribe to do with employee time management and things like that. So it's a very versatile product, which is why, because if you imagine a local council that's involved in so many different activities, whether it's waste management or collecting council tax or all these sort of things, having a tool like Kintone can bring all of that together, streamline all these processes, and basically you actually end up requiring fewer people to do the sort of things that you were doing with a larger number of people before. So that's a core offering that Cybozo has.
I'm curious how you think about valuation. You've mentioned a few different methods. You talked about some of the parts for SoftBank. I imagine a company like Cybozo, it's probably much more maybe looking at an earnings multiple relative to peers or even peers outside of Japan. Or so, yeah, it'd be helpful to understand your valuation methodology and also maybe how that's evolved over time, just given your experience in Japan as an investor.
So when I started with the Japanese team in 2010, I'd done 2 years US, EM, Europe, learned a lot of these valuation techniques, and done my CFA level 1 exam as well, all excited. So I jumped straight with all these DCF models and their terminal values. And then someone in the European team gave us a session on doing reverse DCFs. I don't know if you guys have heard of it. So this is basically where you figure out what the growth rate assumption is relative to the current share price. But very quickly, I realized that all these things are a bit of a waste of time. I'm being a bit too harsh there. But what I mean when I say that is because these models are so sensitive, even to the smallest kind of tweaks and inputs, sometimes you don't really get a good feel. So eventually in Japan, I realized that just the usual earnings multiple and comparing them with peers, both in Japan and globally, is more than enough. And again, as I spent more and more time, I realized that for me at least, the most helpful metric that I found was EV/EBIT, not even a PE, but EV/EBIT. And that's because it factors in the capital structure of the company, and with loads of companies in Japan with cashed up balance sheets, as you were saying earlier, sometimes the valuation doesn't really factor in. It almost puts a zero value on the net cash position, which I think is a bit bonkers. Right. So factoring in that, an EV gives you a very reasonably rough representation. And as an EBIT or an operating profit, again, because Japanese companies have this thing called recurring profit and they tend to have quite a few items below the operating line. So to get a true understanding of the underlying operations profitability, I've always found an operating profit or EBIT to be a much more cleaner figure, shall we say. So an EV/EBIT is something that I've consistently used for many years. Again, with the caveat that it varies with companies. I won't be using EV/EBIT for a SaaS company because there's no EBIT. They're all making operating losses. And so there we are price to sales or an EV to sales type metric. But generally speaking, an EV/EBIT is what I've tended to use the most.
A question that I always like to ask other investors is whether there are particular books, podcasts, blogs, or periodicals that you've relied on and I guess that have really helped to inform who you are today as an investor. And thinking we have some younger listeners, or there might be books that others have not heard of. Any that stand out to you?
Yeah, so there's this very interesting blog called Made in Japan, which I would recommend. But yeah, I mean, in terms of books, so if you're talking of Japan specific books, there's one book called, I think it's got a slightly corny sounding title. I forget the name, We Were Fire or something like that. And basically, it's a history of post-World War, how Japan became this industrial power, all the way starting from electronics side of thing, how Japan became world leader in consumer electronics. And actually it goes to the history of how a lot of these Japanese pioneers, all the way from Matsushita to founder of Sony, etc., they actually borrowed so heavily from the US. So you remember there's this company called RCA, the Radio Corporation of America, that had the largest number of patents in the world at some point, apparently. And they had a close collaboration with all of these Japanese companies. It's a bit like what the Chinese have done more recently, right? You invite people to come in and establish high-speed rail networks, and you have a collaboration with a state-owned firm, and then eventually you take all their secrets and you build your own national champions. So now it's the Chinese who are building high-speed rails everywhere else. It's a very similar model in the consumer electronics. It just tells you the way that's evolved and how the personalities of some of these founders came through as they built these mega businesses. But other than that, I mean, there have been more kind of non-investment type books that I've read on Japan, more on the cultural side. So yeah, so there are a few other books, but these are non-investment books, more on towards the cultural side and just trying to get a sense of some of the more quirkier aspects of Japan. So Geek in Japan would be another book that I think is quite interesting. And there's another book on Hello Kitty, which I thought was quite entertaining. If you want to learn more about Japan, it's the non-investment type of books that I would recommend reading.
I think the book that you previously mentioned was We Are Burning by Bob Johnstone, just to make sure the listeners can find it.
There's another one, sorry, I just remembered. It's called A Salaryman's Handbook or A Company Man's Handbook. One of these. It's quite an interesting one, just to give you an insight into the corporate culture in Japan.
I love it. These are books that I think can be really different from what people usually recommend. So these are fantastic. Thank you so much. I'll be sure to link these books too, so people can find them and purchase them if they're interested. I want to close on the whole Japan market. You've gone through some extreme cycles since 2010 for Japan, but now we're starting to see this completely different scenario for Japan. We're entering an inflationary period. Things are slowly starting to change in potentially in the right way. What do you see coming in the next decade for Japan? Are you optimistic about the changes? And if we ever talked about this 10 years from now, what do you think we'll be saying about Japan?
I'm generally an optimist by nature, and I love Japan. I'm a bit of a Japanophile, so I will always be positive about Japan, which is, I suspect, I'm probably the last person you should get views on in terms of the Japanese market. But I think, as you said, there are quite a few positive developments that could have long-term ramifications in a number of areas of things like the central bank policy, or just this whole idea that inflationary pressures are becoming more embedded in people's expectations. So that should have a very significant impact on their spending and consumption habits, which again, in turn, if you think that Japan still is about 70-80% cash-based economy even today. You just look at the sheer scale of deposits that the mega banks have. It's the biggest in the world. The BFG, I think, is the largest asset base in the world, or maybe at least definitely in the top three. What does this do to that pool of savings? Where does that go? So that's a very interesting question to think about. Obviously, demographics, that problem is not going to go away. So could we actually see a further liberalization of immigration? So that also isn't out of the realm of possible. Already we're seeing, obviously they don't want to upset a lot of people, so they're trying to create workarounds to get more people to come in. So does that become a bit more mainstream as these demographic pressures start to really bite? Already we are seeing schools closing in some of these rural prefecture schools that have had one or two students. There was this very famous short video of this railway train that ran just for one girl student. I don't know if you've heard of that. I think it's on NHK, I think. Just one girl student, and the train actually ran just for her.
Wow.
So, there's demographics, and there's another thing, program. So there's a village where the entire population has almost been hollowed out. So the remaining people have actually created really creepy looking dolls, and they've put those dolls in front of all of these houses so that any outsider coming in, obviously it'll freak them out, but just to make up the pretense that people are living here. So you're getting some really bizarre stories. So demographics is likely to have some hopefully positive implications. Healthcare is another one. So if you're getting a lot more older people, what does that do to the provision of healthcare? More robotic surgery sort of thing. So companies like Sysmex, Kawasaki Heavy are quite active in that area. Drugstores, do they become the next big growth opportunity? Your Sumi Holdings, your Ruencia, all these big players, they've already done quite well, a bit of consolidation. So, there are any number of ways in which you can extend this sort of thought process. So I think personally, the next 10 years should be quite a good one for growth investing, in particular in Japan. I think all this value-based stuff, these are all companies that have a shelf life. Right. Once that value is realized, what next? Because there's no real growth angle to these companies. The one thing I would say, though, is my sense is that the stocks that have worked phenomenally in the last 10 years might not be the ones that do phenomenally well in the next 10 years, precisely because of these reasons. So we might see some new winners emerge from a share price point of view.
One final question I thought about asking my readers on Made in Japan love, and I keep getting feedback on this, which is that I always share my personal favorite places to visit or eat in Japan, because I realize a lot of them do visit Japan, which is great. What's something about Japan that you wish more people knew about? It can be anything from a place or a food or an experience or otherwise.
The first thing I would say to anyone even thinking about Japan, whether it's visiting or whatever it is, Japan is not Tokyo. I think that's the big mistake people make. I've always encouraged people to actually spend as less time in Tokyo as possible and then as more time possible just traveling around to some of these other regions. So that's the first thing that I would say, whether it's an investor or just someone traveling as a tourist. And yeah, I think it's a very different country. Numerous things that are quite weird about it, but equally a number of things that are absolutely phenomenal about Japan. And you've got to spend at least some reasonable amount of time to get a sense of how the country works, what it can offer, and just the whole attitude of people, the whole service-oriented culture, and how things are over-engineered for a particular reason. It's not just because people have nothing else to do. So appreciating all of that does take a bit of time. Visit Japan, less time in Tokyo, and have loads of food. And my favorite is the okonomiyaki in Osaka. That's always my favorite. And also Osho Gyoza.
Sorry, I said final question, but you talked about going outside of Tokyo in one of your previous interviews. You've mentioned visiting places like Tottori for research. I'd love to hear a few anecdotes of places that you might have been to. It can just be Tottori itself and why that was an interesting experience for you, what you learned there, and what the realizations were.
Again, trying to meet different companies, I always endeavor to spend more time outside of Tokyo. So Totori, there's a company called Nippon Ceramic or Nisera, which makes ultrasonic sensors, which go into all these parking assists, ADAS, etc. So they're based in Totori. Been there 2 or 3 times. Equally, there's another company that makes sensors for factory automation and security systems called Optex, which sits on Lake Biwa. That was again quite an amazing visit. I think the main thing for me visiting all these sort of regional cities is just the realization that for all the talk of demographic challenge, etc., or all the industrial activity moving closer to Tokyo, there's still quite a lot happening in these regions. You still see people in malls. It's not as if the whole thing has been hollowed out. Loads of manufacturing plants, chemical companies, etc. You see new malls being built, which is precisely the reason why I say rather than just believing this high-level narrative, what the FT writes or the New York Times writes or the Wall Street Journal writes, those are all very high-level generalizations. Unless you actually go and see what's happening on the ground, you will always work with potentially overstated assumptions, which might mean that you might miss out on some fantastic investment opportunities. Yeah, so just trying to be a bit aware that sometimes all these generalizations might not reflect the reality of the situation is a good place to start.
Where can our listeners find you? Is LinkedIn the best location?
My profile is there on LinkedIn. So if anyone wants to get in touch, more than happy to have a chat. But yeah, I think that's probably the easiest way. I'm reasonably active on LinkedIn, so you should hear from me pretty quickly if you bring me a message.
Praveen, it's been an absolute blast to be able to talk about Japan with you and the opportunity in the smaller growth market for Japan. Thanks so much for your insights and thank you so much for your time.
Thanks so much for having me. Cheers.